morning. It's 9 a.m. here in Hong Kong, in Beijing, and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne Man.
Our top stories this morning. Chinese markets bracing for a fresh challenge with January's PMI numbers out this hour. Unlikely to show a significant turnaround in the economic recovery. Big tech earnings testing the strength of the AI-fueled boom. Revenue from Alphabet's core search business disappoints, as does Microsoft's cloud growth. And Samsung also dampening optimism about a fresh surge in chip demand with its fourth straight quarter of profit declines. The stock is heading lower here this morning. But yes, you got to wonder when it comes to the Mag 7, were those earnings estimates just a little bit too high to deliver, really?
Yeah, the bar was, well, it seems looking at these after-hours moves. I mean, Microsoft's numbers were decent.
Yeah.
And then the markets fell. AMD, for good reason, they came out with fairly soft guidance. But,
and it's Fed Day.
And it's Fed Day as well, yes. And, these markets have been bid up substantially too, right? And going into today. So reason why when you look at NASDAQ futures, QQQ, which is the ETF that tracks the NASDAQ, seeing some pressure in after-hours trade. Fairly sharp declines we're seeing on the index futures right now, 0.8%. We're poised for maybe a flat open onshore China. We're coming off quite a steep price drop on Tuesday. Bottom of your screens, of course, all these after-hours trade. Also coming out this hour, PMI numbers for January, where we are expecting to see an improvement. It will be about really the more granular bits with the PMI numbers as well. We talked about Samsung, so Kospi and Samsung are down. Well, Samsung is down. Kospi is still holding steady. Within the chip story, actually, so we talked about AMD and Samsung. Chip exports out of South Korea, I guess, bolstering the case that that part of the export categories will be boosting growth this year, up the most since 1997, 114% pickup in December. We're continuing to track, and as you can see, we now have 2.43% handle on the Chinese 10-year yield. This is a level we have not seen in at least 22 years. It's continuing to rally. It's month end. While the equity market is bottom of the barrel, the bond market in China has been top at the very top and beating and outperforming peers. It is Fed Day. Implied vol on the euro, for example, on bottom of your screens, up 5 points. It's substantial gains there as well. And it's looking commodity markets. We are poised for a mild gain this January. There we go, across some of the sort of key components here. Particularly within energy.
Yeah, and there's a lot of talk of what's going to happen in this Fed meeting and how market moving will it be, right? I mean, are we finally going to see some sort of, announcement that this rate cutting cycle is going to begin? And, you have many banks talking about, look, it's going to be the language about how they talk about tightening, right? Are they going to remove that sort of upsized rate bias? That's what Bank of America is hoping for. And, there's still, though, some chance of maybe this divergence that we're seeing with Fed and markets. They might still be vulnerable to some sort of hawkish commentary out there too today if we hear from Jay Powell.
Yeah, it's not simply black and white, I guess, is the point also, to your point of Standard Chartered. And, what they're saying is, the Fed might need to open the door to the possibility of a March cut, although that's probably not the base case. Markets seem to suggest it's more in May.
It's going to be May. I've been thinking about it all morning.
Well, it's going to be Mark Cranfield is with us now out of Singapore to give us his take. Not so much the in-sync version of this Mark Cranfield, but okay, riddle me this, Mark. I'm looking at Fed Fund futures. There's still a decent probability there being priced that they cut in March. Why would anyone take that side of the trade if it seems as if Fed officials don't prefer March to be the start of their cutting cycle, easing cycle?
Well, actually, based on the PCE data which the Fed prefers, there is still an outside chance that March could happen because they like this 6-month core PCE on an annualized basis, which has come in below 2% for the past two readings. So in that respect, it's hitting the target that the Fed is looking for. That probably isn't enough, actually. They probably want even more because the jobs data at the moment is still a bit too strong. But if you look at the number of companies which have been announcing layoffs in the past few days alone, there's several high-profile companies who are cutting more jobs. The Fed will be aware of that as well. Put it all together, it's probably still not enough to push them over the line for March, but you probably can, as some of those analysts are suggesting, removing the tightening bias seems like a pretty good chance of that happening, which will certainly give a dovish spin to whatever the Fed has to say. So traders are probably, there's some people left still thinking that March is a possibility, but your upside downside risk on the pure trade is pretty small actually by this time. More interesting is what happens from May, June and thereafter. And some people are talking about a chance for the curve to re-steepen quite sharply. Now that would be a very big trade. If the Fed gives a dovish spin, you could see some very big swings in the longer end of the curve relative to the short end, and that's where some serious money can be made.
Okay, so what are the chances of that? I mean, people are talking about the sort of the upside in yields that we've seen recently. Is it time to fade that in some way, Mark, and where?
So really, if the Fed is a dovish narrative, it's the 2 to 5 year sector is going to be the most bullish part of the Treasury curve. Long end yields will probably go up a little bit, but what you'll see is a much bigger swing down in the 2 to 5 year sector. 5 year especially is a favorite for the fast money crowd. So you'll see a big jump in futures trading, and you might even see the 2 to 5 year actually go slightly positive, which it hasn't been for a very long time as well. So you'll see big turnover, high volatility, a major adjustment in the curve. Might even be enough to flatten the curve completely at first, and then with the 2 and the 5 years going below the 10 years in the next couple of days. So plenty of activity in that respect.
Mark, before you go, just a quick word on China here. Month end, equities have been underperforming. There has been some intervention, if you will, coming off the bottom. At least markets thinking that there will be intervention at the very least. But bond markets have been outperforming. What do we need to know or keep in mind as far as January is concerned, just looking ahead now?
Well, really, a lot now hinges on what the creditors do in respect to these other companies like Evergrande. So you've got Sunak, Kaiser, a few others. That decision about the liquidation should pressurize the creditors into coming to a quicker solution, which may be slightly positive for the market overall if they can avoid letting the courts decide for them, if they can come to a better solution. Of course, also people are watching very closely to see whether onshore assets are allowed to come into part of the Evergrande picture. That's a bit of a long shot, but that would definitely help everybody. So while you've got that overhanging the market, the Chinese authorities really need to come through with this support package that was talked about over a week ago. They really need to start delivering it, because the negatives coming out of Evergrande and those kind of situations are really very big. And you need to turn sentiment around quickly. There's not much they can do about January, that's a write-off. But they need to get the sentiment improved for the post-China New Year period. That's very important.
Mark, thank you. Mark Cranfield in Singapore for us. And in about 22 minutes, the market opened, and the first set of January economic indicators, PMI leads the way here. An improvement expected in both services and manufacturing. Might have also to do with the fact that we have Lunar New Year, of course.
Yeah,
in January.
we're going to have Hao Hong a little bit later on at the bottom of this hour. He says there's a lot of holes in this data set that maybe you're not going to get a clear read of what this means in terms of the recovery in some ways. But yes, there is that seasonal boost, just given the fact that we're getting closer to that Chinese New Year holiday. Maybe these numbers could be revved up on activity. We're going to take a deeper dive there, of course, with Hao Hong, as we talked about, Grow investment partner and chief economist, joining us to reflect on those numbers coming up. And before that, we got Hang Lung Properties coming.
Yeah, they released their earnings around lunchtime in Hong Kong yesterday. We'll get a sense of how they feel about this property market, commercial and residential, onshore and offshore. Adriel Chan joins us in a couple of minutes. Counting down to the open of trade, just 21 minutes away. The opening bell here in Hong Kong, in Shanghai, and in Shenzhen. This is Bloomberg Markets China Open. Good morning.
All right, we're going to watch very closely what happens with this stock, Hang Lung Properties. Basically, their earnings came out yesterday. We saw quite a bit of a steep drop there on the shares. Profit missing estimates, mainly due to that weaker rental income as well. And talking about underlying profit for the full year declined 2.4% from the previous year. Our next guest is set to also become the company's new chair. That was the news that came out as well, taking the reins from his father, who is retiring. Let's bring in Adriel Chan, Vice Chair of Hang Lung Properties, joining us here. Adriel, first and foremost, congratulations, of course, on the upcoming role. I want to get to that in a second, but let's talk more about the earnings. This is a market that's quite bearish about the industry right now. What's the message for investors here right now? When do we actually see a bottom in home prices here?
So second half of 2023 was a difficult period. That being said, actually, if you dive into the numbers a little bit more, we eked out 8% growth in RMB terms. So we suffered a lot from that RMB depreciation. So I think 8% is pretty respectable. The high end, which is where we mostly play, has actually done quite well. It's still very resilient. Customers are still coming out. Of course, there is some travel, mostly to Japan, but they're still buying in China as well. So we do see a little bit of pressure from the outbound travel, but high-end sales holding up pretty strong. I think what's more interesting is the mass market sales. So retail, which is at a little lower price point, that's been a little bit more challenging. Thankfully, foot traffic has been back up in those sort of sub-luxury malls. And so that's keeping us afloat. I think, the winner in this case really will take all.
Okay, so foot traffic's there. What's spending looking like?
Spend is definitely down a little bit. So we're seeing in mass market, baskets are a little bit smaller, but in the high end, actually, basket size is actually larger than it was prior to COVID. So we're doing all right.
This is mostly in China, right? You're talking
This
about?
is mainland China, sorry.
Okay.
Yes.
Yeah, let's talk about China then, since we're here. Obviously, we had the news of Evergrande and this saga and this liquidation. I mean, is there now appetite from you guys to look in some of the projects in mainland China?
We've been looking in mainland China for several years now.
Have you found anything?
No, we still look. Unfortunately, we haven't found anything that really whets our appetite that much. I think, as our current chairman says, it is still a time to be cautious. So our hurdle rates have definitely gone up. There's a lot on the market, but we have to be very selective.
So when you talk about hurdle rates, is that what? Is it criteria or is that the interest rate?
Criteria in terms of what it would take for us to make a big capital investment. Okay,
well, there's been some concern, perhaps not in your price point, around commercial property as well. When do you see that overall segment improving in mainland China?
That's the big question. 2024 budgets, I would love to know what all of our peers are budgeting for 2024. I think what we're expecting is still growth over 23. We're definitely going to push the teams very hard to show us growth, but that will be a bit of a challenge. Our chair has come out and said that 2024 may be the first year in 25 years where we have a down year in mainland China. That being said, I'm still cautiously optimistic that we can eke out growth.
Right, and that would be a function of, if it is a down year, and we're very early on in 2024, that would be a function of what? Just overall leasing rates, for example, or?
It's really market sentiment. So leasing rates are still good. We're still sort of 80-90% in most of our malls and office towers. But the concern is, do consumers have the sentiment and that sense of really wanting to spend?
You have some luxury service apartments coming online there in Wuxi, Wuhan, Kunming. Does it affect any of your plans to sell those properties?
No, we're still very keen to sell these. We've had a bit of a slow start. Partly because these are commercial titled properties rather than residential titled, which actually has a slightly different market dynamic. So eventually I think we will benefit from a pickup in consumer sentiment for residential when that comes. But I think the first reaction to commercial will be a little bit more lukewarm compared to the market for residential when these government not subsidies, but these government measures kick in.
Have you... Speaking of lukewarm, has it forced you to adjust pricing in any way, or is it simply pushing back timing?
There's definitely a look at pricing. You want to get traction when you first launch a product. But it's we have the luxury of not being so highly geared and not really being in that corner that a lot of our peers are in order to have to sell.
Right.
What do you make of the housing measures that we've seen? How supportive do you think, and at least slowing down the sales momentum or the selling momentum, I guess?
We really have to wait and see. I think in some ways there could have been an even bigger punch. That being said, it's clear that the government now realized that they need to kickstart this motor, and if they can get that done, I think it'll be all right.
And here in Hong Kong, It's similar dynamics, perhaps down to different factors. We obviously import the interest rates from outside as well. What do you make of this housing market?
Hong Kong, I think high end will still be good.
Okay.
We're still trying to bring in talent from the mainland. Hong Kong's still a great place to live and work. So I think high end will do all right. That being said, I think mass will still be under pressure. I don't know how much farther lower it can go. So hopefully we found a bit of a bottom there. But I think the reasons for upside are also limited.
Do you think the government should be relaxing some of these property curves in the city?
In Hong Kong, I would love to see that, absolutely.
Do you think there's appetite for that, though, politically?
You know, I think that there could be. What we've seen a lot of is sort of a willingness to listen,
Okay.
and hopefully there's that, in turn, willingness to act.
Right.
How do you see, I mean, there's this whole trend now of right? Everyone's talking about going up north. I'm going to go to Shenzhen and eat and buy stuff and now come back. Spend
Or
a whole
live there
weekend
and come here to
or
work.
commute
Yeah.
to Shenzhen and work here. I mean, how do you think that impacts, overall just Hong Kong as a market and just spending? Are people just spending less here?
So the way I look at it is it really should be two-way. Hong Kongers like to spend time and money in Shenzhen, but Shenzheners, I would like to think, also like to spend time and money in Hong Kong. Hong Kong, I still feel like is a easier, more convenient, better place to live. But
You're not
there's
seeing that,
definitely
right, from the Chinese tourists. They're not coming here as they did back in the glory days.
Not in the same numbers.
Yeah.
But I think that what Hong Kong needs to do is really step up our marketing and show people, tell people how good life is here.
Yeah.
I mean, certainly the profile of the tourists has changed. They're taking more pictures. They're spending more on matcha lattes than they are buying, I don't know,
Handbags
and luggage, what have you. On just sentiment here, and not specifically for you guys, I've had a look at some of your bonds. They've actually held up quite well. I think you're still near par. Some of your peers in the industry have seen some further pressure on their bonds. Do you think the market's overly concerned with leverage in the industry, in your specific industry?
Among high-quality names, I don't think there's any reason to be concerned. Obviously, you look at the peers and there's a pretty mixed bag. So I would be more cautious on some of the other names, although I'm very, very confident on many of our peers here in Hong Kong.
We got to get to the news of the retirement of your father, Ronnie Chan. Obviously, I think it was a bit of a surprise in terms of the timing, but I guess you've been in vice chair this position for some time now. Have you been prepared for this leadership role? What are you looking at in terms of strategy?
So I've had the opportunity to spend quite a few years, so now 13 years, coming on 14 in the company. And so I know the markets very well. I know the organization very well. And I think that I've been pretty hands-on in terms of shaping the strategy over the past decade. And so it's as much mine, sort of, as it is Ronnie's, our outgoing chair. So, I don't see any reason for us to need to change that strategy. Obviously, we have to react to the market. We have to be fast to react. We have to be innovative. We have to be thoughtful, open-minded. But I think that we're on the right path, so no big changes expected.
Okay, but suffice to say, though, you're excited to take the role?
Very excited.
Okay, we kind of missed that, if you want the job or not. All right, Adriel, thank you so much. Great stuff. Adriel Chan there, of course, Vice Chair, soon to be Chair, of course, at Hang Lung Properties. Right, just under 9 minutes to the opening bell, and we're looking at some weakness here in Hong Kong. A50 futures have actually picked up a little bit, but this world-beating CGB rally continues. We now have 243 handle on your 10-year yield. A preview of the trading day ahead, plus, of course, PMI numbers coming through in a couple of minutes. You're watching Bloomberg Markets, China Open. Good morning.
Well, the IMF has raised its forecast for global growth this year on better-than-expected expansion in the U.S. and fiscal stimulus in China. The chief economist told us that persistent risks from wars and inflation could change their latest outlook.
So we have 3.1% growth for 2024. That's a 0.2 percentage point increase compared to our October forecast. And there are a combination of factors. We see a lot of resilience in a number of economies in the U.S., in China, and in many large emerging market economies, Brazil, India, Southeast Asian economies, Russia. So all of this together, that's what is lifting the growth number for this year. Behind this, what we see is strong demand in some countries, private consumption, public consumption, but we also see supply side forces. We see the unwinding of remaining supply chains restrictions. We see energy prices coming down, and we see a lot of strength in labor markets.
Is China, though, a different story now? I mean, given what we've been seeing over the past few weeks, especially when it comes to the property sector, is there a concern?
Well, there is a concern with the property sector. It's a concern that we already had back in October. The property sector has not been doing well for some time now. And what we're seeing is that's one of the reasons why we have slightly lower growth for China next year compared to this year. So we're projecting 4.6% in 2024, 5.2% last year. But that has been revised upwards because we have also, the Chinese government has been implementing a fiscal package that is trying to support consumption, trying to support households and investment. And that is having some impact on growth.
Is it enough, though? Many people are saying that it's not.
It may not be enough. I mean, we are concerned that this is still going to weigh down on output growth in China in years to come. We're also concerned about the more medium-term growth prospects for China. They seem to be coming down from sort of the turbocharged growth we've had in past decades, and that's something that has to do with declining productivity growth, declining demographics. So there are a number of headwinds for the Chinese economy.
Yeah, there we go. Our colleague Jennifer Zabazaja with the chief economist at the IMF. Now, going into this Chinese market open, just under 5 minutes away, futures are called, initial pricing in Hong Kong at least is pointing to a lower open today, consistent with, anyway, what we're seeing across the region, if not actually doing slightly better than markets like Japan, for example, or NASDAQ futures, which are pointing down. 10-year yield still continuing to push the limits of this, 20-25-year range, 2.43%, lowest level in about 24 years.
Yeah, there's that divergence there that you're seeing across stocks and bonds here, and we're watching very closely what that means for some of these equities, EV-related stocks. On the back, we had a lot of earnings coming through from some of these battery makers like CATL, actually pretty strong results from that company. Chip stocks as well, just given what we saw from AMD, given what we're seeing with Samsung here today. And of course, we're just minutes away from that January PMI number and fourth quarter GDP numbers coming out of Hong Kong a little later on this afternoon. Here's what the chip stocks are doing. Slight pressure for SMIC, Hua Hong Semi, but look at Prada. We're down 3% here. Obviously, there's been a lot of talk about what this means, the China consumption space, the China market. Sunny Optical Tech also out with those earnings. We're down 4% for the stock. The open is next.
Could face bigger challenges.
Britain's next
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Welcome back to the program. You're watching the China Open. Just 40 seconds to the opening bell. Also 40 seconds to the numbers coming out of PMI. So these are coming out, at about the open, and looking at estimates right now, 49.3, 50.6 and the other. Improvement on both. Is that a reflection of underlying improvements? Is this more seasonal with activity getting front-loaded ahead of Lunar New Year, of course, which takes place in February? Who knows? We'll see. Yeah, we'll see if that actually impacts the market in any way, just given we've got a lot of, I guess you could say, the Fed tension around that. The Mag 7 earnings that came out certainly disappoint the market. So maybe we're watching the tech space very closely here if there's any sort of fall-on effect here. And we're watching very closely what goes on with earnings here in Greater China as well. We talked about some of these battery chip makers and the like. So here you go. You have the CSI 300. We're continuing that downtrend here for a fourth straight day at the get-go. We're down just 0.4%. Hang Seng, though, we have Hang Seng and HSCEI among Asia's worst performers, I think in the world too, right? You could, but Hang Seng Index and Hang Seng China
in January as we wrap up the trading month. So we're carrying on the pessimism, and what we saw last week, that optimism that really was quite short-lived now after some of those policy measures that we've seen. Chinese CGBs, though, that rally continues. We're down some 3 basis points for your 10-year at 242. We're still well below, I think it's a new 2002 low or new low. And we're watching, of course, what goes on when it comes to HS Tech. There you go. We're down 0.6% here. We're flat when it comes to the currency. Iron ore is down some 2% in Dalian. And we got some numbers coming through now. Yeah, 49.2 on PMI. This is for January, of course. The estimate was for 49.3, so slightly on the weaker side of the median forecast. Non-manufacturing PMI coming in at 50.7, so that's actually coming in slightly above the median, which is 50.6. Composite at 50.9. Okay, instant reaction. Let's get a sense of what this means for the economy and what this means for this equity market, which has been rallying, but to only a certain extent, and then we fall back down to earth. Hao Hong is with us here on set, partner, chief economist, Grow Investment Group. Good morning.
Morning.
What do you think? PMI?
It's been 49 for a long time, right? So non-manufacturing has been 50 for a long time. So I don't think on the margin it's telling you anything that is valuable, because this is a survey-based number, right? So when you ask people in the questionnaire, how do you feel about the economy, you tend to get a dishonest answer these days, right? So I would say that, on the margin, it doesn't give us any valuable insights into how the economy is performing. And also on top of that, because we're now 1 week away from the Chinese New Year, which is huge in the Chinese calendar, people are just saying their mind free and off to holiday already, right? So I think this tends to be a quiet period as well.
What can we expect in the New Year holiday? Obviously domestic travel is a big thing.
That's right.
How are we looking at spending? What are your expectations?
I think in many ways, consumption has been holding up quite well. We're seeing volume expansion, but then I think average price per order is actually decreasing or flat year on year. So as a result, we're not seeing a substantial bump on consumption. But having said that, given this is a huge holiday on the Chinese calendar, so one would expect that people start to travel, start to spend some money, but on lower end stuff.
What do you make of, on aggregate, all the policy pronouncements from December? So whether that's PSL on property and banks to some of the, the latest ones on the market, for example. Do you think the tone has changed? There's more urgency right now in the policy response?
I think it's steady as she goes. Right? So if you look at the minutes from the Central Work Conference, right? So it's saying, wow, we're going to keep the monetary policy steady as usual, blah, blah, blah. So basically, you don't get a huge sense of urgency. But I think the authority is really paying attention to the movement in the stock market, right? In the sense that, the downtrend seems to be very difficult to stop. So, there have been rumors about a 2 trillion yuan stability fund, but we haven't seen any details. The PSL is like 350 billion yuan, which is substantially less than hoped. Right? So last year, this time they did 850 billion yuan. Right? So it's substantially less than what they did in 2022. So all in all, as you can see, the market is not reacting sort of favorably towards these policies.
Obviously, we got to talk about Evergrande with this liquidation order this week. Obviously, it does show that this housing crisis is far from over in some ways. But is it a signal to you that we're not going to see policymakers really bail out these developers? Is that sort of the clear message from this?
Yeah, well, I think the policy towards the sector has been supportive rather than stimulating, right? So it's trying to relax, for example, purchasing curbs on properties in many cities. For example, a few days ago in Guangzhou, and also last night in Suzhou as well. But the problem is that, because they're doing it on a piecemeal, piece by piece base, then it's not sort of getting the response that you're getting, you used to get, many years ago. And also at this juncture, because the Chinese household has leveraged up so much, right? So if you ask them to borrow more to buy more property, is a big ask for them.
Yeah, I'd also add, I'm not sure if you saw that Shanghai overnight also relaxed rules on home buying for non-locals. But I guess to your point, it's just more at the margin.
Yeah, I think, it's talking about, further away from the city center, for people who has paid, 5 years Social Security but doesn't have a Shanghai hukou, that kind of stuff.
Now, as far as the market goes, for investors with relatively higher risk appetites, for example, would you be recommending funds that are starting to get exposure to these high-yield bonds, for example? We've had a guest on this week that said they're starting to pick the survivors.
The Chinese high yield.
Chinese high yield, dollar bond, the offshore bond market.
I don't know, there are like better investment opportunities somewhere else, right? So for example, just now...
cash deposits?
Well, Yvonne said the Chinese treasury bonds yield is making new low, right? So I think without any drama, it's going to continue to make new low in the months to come. Because China doesn't have inflationary pressure and the economy is still, struggling to find footing. Therefore, I wouldn't be surprised to see, the treasury yield continue to trend lower.
Yeah, I like this Bank of America fund manager survey note that they said China stocks are the world's most enticing contrarian long trade, but no one believes it's an investment. That just goes to show where sentiment is here still. I wonder, though, you said now the markets are even lower than where your forecast when it comes to trading ranges.
That's right, yeah.
Are you looking at some new trading ranges now?
Well, not yet. I mean, it's a tad below, right? So, I was looking for slightly below 3,000, and now we are like quite a bit below 3,000. So, it is not positive, to be honest. But then at the same time, we shouldn't be changing our forecast, based on a few days of, dramatic movement. So let's just wait and see. Like, let's, for example, if we can get more details on the stability funds, right? So then you would expect a strong rebound, a strong technical rebound from the market, et cetera, et cetera. So I'm not giving up hope just yet, but then at the same time, the market is not going as we planned.
There has been, and I'm not sure if this constitutes enough evidence of intervention, there's been a massive inflow into the ETFs that track some of the indexes. Would you consider that enough proof that there has been, short of official confirmation that, yep, we're intervening in the markets? Do you think that suffices?
Well, I think judging from the market reaction, right? So when you see this announcement that, the national team is buying ETFs, then you get a one-day rebound in the market, and then, it's sort of, fall off again. The problem, with this approach is that, if you remember in 2015, right? So in 2015, the national team bought individual stocks. But then, those stocks all blow up, and then, they lost a lot of money. And so this time around, they're buying broad-based ETFs. Now, the problem, with that is that it sort of influence the movement of the index. But then there is a structural product called snowball outstanding, right? So we are now dangerously close to the level where the snowballs is going to be effective, come into money. And then, so the other investors who don't have the snowball product, they would opt to sell first, because, the danger of these options being executed is quite high. And therefore, it's a monumental task for the national team, right, to buy. How much are you going to buy, because there are like a few 100 billion yuan worth of snowballs outstanding, right? Yeah. So you have to spend a lot of money to buy up the index.
I want to talk about just geopolitics. I think even just a hint of reports on tariffs, for example, can send shares this week to PDD, Miniso in a free fall. You've seen a hit on solar, biotech.
That's right.
Is this just a glimpse of what's to come in a U.S. presidential year?
I think the likelihood is rising, right? In a sense that if you look at the policy choice for China, right? So if we stimulate big time on the economy, right? So all the stimulus money goes into all this high-tech manufacturing stuff, which is precisely the sanction target by the U.S. government. And so therefore, if you stimulate too much, it's sort of inviting political response from the U.S., right? So therefore, it sort of limits the room that you can stimulate. If you stimulate domestically, right? So let's say if you stimulate the property sector, property price hasn't corrected, right? So the property price is still elevated, right? So it is very different from the other property cycle that you see in the overseas country where, in down cycle, property price just collapse. Right? So if you stimulate stimulate domestic economy by stimulating the property sector, then the property price go even higher. The bubble gets inflated even bigger, and it's gonna, make the economy pay a higher cost somewhere down the road. Right, so you're between a rock and a hard place, and that's why I think the market is sort of lingering in a negative territory.
Hao Hong, thank you. Always great to have you. Grow investment partner and chief economist joining us here. I just want to check some movers. Of course, obviously we're focused on the tech space, just given what we saw with the Magnificent Seven, Alphabet reporting earnings, Microsoft as well. Samsung shares are now down 1%, so we're watching the chip stocks very closely. SMIC, though, is actually up 10 cents up. Alibaba slightly lower, not a huge reaction. But Sunny Optical, that's the one. So it was a profit warning for 2023, basically missing consensus, according to Bloomberg Intelligence, by 14 to 23%. They're thinking this might mark the bottom of the cycle for the company. But right now, shares are significantly lower. Watching movers like EV makers, for example, given the drop that we saw yesterday on BYD on their earnings, we're stabilizing a bit, but still seeing some pressure. But look at CATL. So robust sales. They talked about profit rising nearly 50%. To $6.3 billion. So battery makers are still doing well, at least CATL is. Ganfeng Lithium, Tianqi Lithium also come up with their prelim numbers there. Those, though, have been seeing a bit of pressure on those stocks. Plenty more ahead. This is Bloomberg.
Right, welcome back to shows. So we're looking at, after hours trade, Alphabet, of course, we're in the thick of extremely busy earnings season. You have the big ones, of course, coming out. So you have 5.8%. NASDAQ futures are pointing lower because of what's happening here. You'd have fourth quarter revenue, core search, advertising unit here fell, short of fairly lofty, I should note, estimates out of Wall Street. It's overshadowing what would otherwise been a very strong year. Ed Ludlow out of Bloomberg Tech, of course, our co-host there, digs into the numbers for us. Have a look.
It was a negative and severe reaction to what was a very slight miss in the core search business. Revenue for ad search coming in at 48 billion. The street was looking for 48.15. And that's interesting because there was some areas of very significant outperformance. If you look at cloud, there was such a disappointment 1 quarter ago. Not only did they beat on the top line, but operating income from cloud was double what the street was looking for at more than $840 million US. And there are a number of factors in that. When I spoke to Alphabet's president, CIO, and CFO, Ruth Porat, she said, yes, generative AI is a contributing factor here, but more significant perhaps in the cloud business is that there was broad-based strength across all the kind of subsectors and customer segments that you'd expect to have cloud spending. Other than that, the focus is on AI, right? And one thesis or idea is that maybe the street's concern about weakness in the search business is they don't yet see tangible evidence that all of the R&D and work in generative AI and all of the product release is actually doing anything supportive to Google's core business. Compare and contrast that with Microsoft, where you see the contribution of AI across its kind of legacy and newer offerings and software suites. It's clearly seeing a top and bottom line effect, but much more to come when it comes to Alphabet, who are focusing on hiring in growth areas, in other words, AI, being leaner in lower growth areas, and they're even talking about moving talent from areas of their business that have a slower growth rate right now to those key areas, which are the cloud and AI. One final thought on the cloud, the surprise on operating income, do think back to the last few quarters where Alphabet guided a lot on the cost discipline and kind of savings they were targeting in that unit. And what Porat told me is that is those savings coming home to roost. Ed Ludlow for Bloomberg News in San Francisco.
Yeah, but some other sort of tech earnings that we're watching out for here today. Microsoft shares paired losses in the late session after its strongest revenue growth since 2022. And the result credited to interest in AI products that are also driving renewed spending on cloud computing. Sales in the second quarter rose 18% to $62 billion. That did beat projections. AMD shares also tumbled in late trading after a weak revenue forecast, and that's even as the chipmaker predicted that new AI processors would generate more money than expected this year. AMD says its first quarter revenue will be about $5.4 billion. That is short of what was estimated.
For a deeper dive into these results, we're joined here on set, Robert Lee, Bloomberg Intelligence senior analyst. Why don't we start with AMD, since we just ended on that? Just your take. How soft do you think the soft guidance was?
Sure. I think AMD on the semi side has been one of the top performers. So again, the cliche, when stocks are priced to perfection, there's only potential downside if the guidance, etc., doesn't come in and meet or beat those very, very high expectations. The core of AMD's business was doing fine. No major concerns from the Q4 numbers, but obviously they're the major competitor to, or potential competitor to, NVIDIA. So they're playing catch up there. And the business is going great on the AI side, but I think, again, the guidance they gave on those AI chips, the MI300s, didn't quite meet the very lofty expectations were there. But then just one other point, which I think is common to a lot of these. Let's get back to the world of reality. The bulk of many of these businesses is tied to very cyclical sectors, whether that's mainstream PCs or mainstream mobile phones. Yep. And that's the reality for a business like for AMD at the moment. So whilst AI is, it will determine the future of AMD's business, the core of their business is still tied to the PC sector. And that's a very cyclical industry, and there are question marks as to how strong that will be this year. And I think that's one reason why their guidance into Q1 was weaker than expected.
And I think AI was clearly the theme in all these earnings. I'm just wondering, in terms of what Alphabet was saying, right? They've been really trying to really capitalize on this, but they're still kind of catching up with Microsoft in some ways. What do you make of this competition now?
Yeah, I mean, again, Alphabet, as Ed just said a moment ago, the corporate side of the business, the cloud side is doing well, but again, they're playing catch up to Microsoft and Amazon. However, same comment I just made, the core of the business is ad-based. It's a search business. That's under pressure at the moment as we go into potential slower economic growth into this year. There's rising competition from other online platforms. That's something they referred to on the call. So again, their growth potential in AI is very interesting, potentially very exciting, but the reality is the core of their business is search and ad related. That is under some pressure, and that's why, again, the stock is off. Because it's the cash flows from the search which underpin these AI investments. So if there's a question mark about the margins or sustainability of that in the short term, then potentially that undercuts the whole story. Plus, one very quick thing, their CapEx guidance, because the costs in AI are very front-loaded, came in a bit higher than expected. So again, we've got a spend to grow, but we suffered a cost, and maybe there's a margin hit as well in the short term. So
for a moment, I was confused whether you were talking about Alphabet or even Microsoft, because you could make some of the same sort of comment, although you do have a sort of a cloud exposure there as well in other assets.
The beauty of Microsoft then, I think it's a much more diversified business than the other. It's got great exposure to consumer, to corporate. Microsoft Azure is, rated number 2 in the States. That business seems to be picking up in momentum, and in fact, the numbers came ahead of expectations. So being a more diversified, broadly spread business, I think, is to their strength. The numbers were decent, and the guidance, there were no major surprises. The only reason why we might see some weakness in Microsoft is, again, when stocks are priced to perfection, even though the numbers are great, there wasn't that extra,
Not good enough,
it wasn't. So, I mean, I think that's more profit-taking than any fundamental concern on their business or their outlook.
All right, Robert, great to have you. Robert Lee there, our Bloomberg Intelligence senior analyst. We got plenty more ahead. This is Bloomberg.
Right, good morning. Welcome back to shows. It's month end, so it's perhaps An opportune time to wrap what's really been an eventful month for equity markets, particularly in China, given the sort of bottoming out. Hopefully that was the bottom, and of course the sort of implications if in fact we did see state buying coming through. Now, as far as inflows to some of these ETFs tracking the CSI 300, as you can see, that's very pronounced. That really picked up substantially. Record surge there as far as inflows are concerned. Now, the effects have been seen, but certainly not sufficient enough. In fact, as we wrap up the month, the two worst performing benchmarks globally, major benchmarks, are in Hong Kong. Hang Seng Index hangs in China, and as you can see, there's a little bit of a pickup once, of course, news started to come out that maybe China was looking to support the market, but certainly not enough to clock us in for a positive month, Yvonne. So far, jury's still out whether or not equity markets have bottomed.
Yeah, I mean, and it's clear, right? Valuations are so cheap, risk reward is better, but they're not getting in, right? And that's where, why, and where are they going into? Well, it's that rotation that you're seeing from stocks to basically bond markets. You take a look at how performance has been when it comes to January. Chinese CGBs have basically been the only bond market that actually have rallied. You take a look at how Bloomberg treasuries, like global treasuries, or how aggregate bonds have looked like globally speaking. There has been that repricing around the Fed, and really how aggressive are they really going to be in this rate cutting cycle when you really haven't heard from policymakers talking about, they're very in a rush to really cut rates. So this is what Hao Hong was just talking about, right? That CGBs may still be that safe hedge out there in this market, and that potentially, now that we've seen new lows for Chinese 10-year yields, it was 2002 lows, that can actually still head lower, Dave.
Yeah, and provide that sort of counter-cyclical, uncorrelated assets that global investors, with everything in 60-40, of course, correlated to the Fed and everything that they do. So PMI numbers came through about, what time is it now, 24 minutes back. So the top line numbers, while you digest the subcomponents, 50.9 on composite. Manufacturing came in slightly lower than estimates at 49.2. Non-manufacturing came in slightly higher than 50.6. We have the services and the Caixin numbers coming out, well, on manufacturing at least tomorrow. Subcomponents, most, not all, showed an improvement from December. Could be seasonal as well, with Chinese New Year, of course, taking place in Feb. So maybe some of the activity getting front-loaded in the month of January. We would look at Chinese benchmarks going into 25 minutes into the session. Weakness almost across the board. And as you can see, the bright spots Yvonne is pointing out there in the CGB space. Plenty more ahead. This is Bloomberg.